Welcome back to Guiding Greenhorns, where we provide easy to understand tips and tutorials about investing in the stock market. There are about 280 publicly listed companies in the Philippine Stock Exchange. So, among these companies, how can we determine which stock is best to invest in? If you're a beginner, consider taking a look at the PSEi, or the Philippine Stock Exchange Composite Index. The PSEi is a stock market index consisting of the 30 largest companies traded on the Philippine Stock Exchange. These 30 companies also represent our local stock market and its performance. Because of this, there are lots of funds that use the PSEi as a benchmark. If you are unfamiliar with funds and indirect investments, you can check out our other videos where we explain the concept of indirect funds like mutual funds, UITFs, and VUL insurances. Investing in funds that use the PSEi as a reference point is never a bad idea, since these funds promote diversification of portfolio, lower risks, and you can easily track the composition and performance of your investment portfolio. If you want to further increase your chances of investing in a profitable company, we would have to look into even more financial information and perform a more detailed analysis of the stocks. This process is called fundamental analysis. Fundamental analysis is a method used commonly by investors to evaluate the value of a company based on its financial statements and other related factors. In fundamental analysis, we combine both qualitative and quantitative data in order to analyze factors like profitability, revenue growth, debt levels, dividend policies, and even management quality. Understanding the business is the first step into a solid fundamental analysis. Before investing in any stock, you should first understand the company's business model, its products or services, and the industry it operates in. Ask yourself these following questions. How does the company operate? Who are its main competitors? Is the industry growing or declining? And what are the risks involved in this industry? Knowing the answer to these questions will help you in speculating how the company would react if there ever was a significant change in the industry. After understanding the business and the industry, the next step is to perform quantitative analysis by examining financial data. The best source for relevant financial data is through the company's General Purpose Financial Statements. General Purpose Financial Statements, or GPFS, are financial reports that provide information about the company's overall financial position, performance, and cash flows. These financial reports include the following. The income statement shows the company's profitability and financial performance by providing a breakdown of the company's net income. The balance sheet, also known as the statement of financial position, shows the company's assets, liabilities, and equity, while the statement of cash flows shows how cash moves in and out of the company, detailing all the sources of cash inflows and into which section the cash is used. Now that we've gathered our data, we have to make sense of these financial statements. In order to do so, we have to use financial ratios. Financial ratios are numerical values that compare different figures from a company's financial statements. With financial ratios, we can determine if the company is truly profitable, financially stable, and has potential for growth. For example, the CAGR, or the compound annual growth rate, is one of the most widely used financial ratios in fundamental analysis because it gives the investor a general overview of the investment's growth rate over a specific period of time. This financial ratio is most effective at the beginning of your ratio analysis since you can easily use the results as a tool to compare the performance with your other investments. Another commonly used financial ratio in fundamental analysis is the earnings per share, or the EPS. The EPS is computed by subtracting the dividends from the net income, then divide by the number of common shares outstanding. The EPS tells us how much profit is generated by the company per share. In doing a ratio analysis, solving for the EPS is essential as a shareholder. By knowing how much profit one share can generate, we can infer whether the shares are undervalued or overvalued. Another financial ratio that can tell you whether the stock price is too high or too low is the price to earnings ratio. It is calculated by dividing the share price by the earnings per share. The price to earnings ratio gives us a more direct comparison of the stock price relative to its earnings. If the price to earnings ratio is too high, that means that investors are willing to pay a premium for each peso of earnings, potentially indicating that investors have high growth expectations for the company. Accordingly, a low price to earnings ratio could indicate a potentially undervalued stock. The best way to use and interpret the price to earnings ratio is to compare it to other companies within the same industry. By doing so, you will get an idea of how much investors are paying for each peso of a company's earnings. Let's move on to our next ratio, the dividend payout ratio. Remember that as investors, we receive a portion of the company's profits through dividends. Therefore, it is crucial in fundamental analysis that we analyze the company's strategy in distributing dividends. The dividend payout ratio, or the DPR, is calculated by dividing the annual dividends per share by the earnings per share. The DPR tells us what percentage of the company's earnings is paid to shareholders as dividends. Meaning, companies with a high DPR believe that paying more in dividends is best for the firm and for the shareholders. Another common financial ratio used to evaluate dividends is the dividend yield. The dividend yield is calculated by dividing the annual dividend per share by the price per share. Just like the DPR, the dividend yield also tells investors how much they can expect to earn in dividends, but this time in relation to the stock price of the company. Looking at the ratio, a high dividend yield can signal strong income potential, but it can also indicate that the stock price has fallen. We can also use our financial ratios to evaluate the company's ability to generate profit and to pay off its debts. These ratios are called profitability and liquidity ratios. Although these ratios are not as fitting as the ones we've discussed before, profitability and liquidity ratios still gives us an idea how well a company uses their assets to create value for their shareholders. An example of a profitability ratio is the gross profit margin. The gross profit margin indicates how much profit a company makes after paying for its cost of goods sold. A higher gross profit margin usually indicates profitability and cost management. As you can see, the gross profit margin is calculated by subtracting the cost of goods sold from the revenue, then dividing it by the revenue. We can also use the operating profit margin in evaluating a company's profitability. The only difference is that the operating profit margin also accounts for the company's operating expenses, giving us a better perspective on how the company manages its expenses. The current ratio, on the other hand, is a liquidity ratio, meaning it shows us how well a company pays off its obligations. The current ratio is the most common ratio used in gauging whether a company is liquid or not. The current ratio is calculated by dividing the company's current assets by its current liabilities. Aside from the financial ratios we've discussed, Feel free to include other financial ratios in your fundamental analysis that you feel would also help in making better investment decisions. After all, there is no single formula for a successful fundamental analysis. It all depends on the investor's personal approach, strategies, and risk appetite. With that in mind, let's address an important disclaimer. Fundamental analysis is a valuable tool, but it does not guarantee profits. The stock market carries risks, and stock prices are influenced by other factors outside of our control. Always do your own research, learn from personal experience, and consider consulting experts and advisors before making critical decisions. That's it for today's tutorial about financial ratios and fundamental analysis. I hope you found this guide helpful, and if you did, subscribe to our channel, Guiding Greenhorns, for other helpful tips and tutorials about the Philippine stock market. Thanks for watching.